Hello there. Well, markets seem to have settled down a bit after the fears from a few weeks ago after Silicon Valley Bank went bust, and then we saw the kind of merger between Credit Suisse and UBS that was kind of forced through by the Swiss regulators. So we think that the sort of risk of a escalating financial crisis, which a few people started to worry about when these fears arose, has certainly receded. We don't believe there's any risks in the banking system. Regulators have been very, very quick to get on top of these risks, make sure banks are safe, and they're certainly a lot safer than they were many years ago when the financial crisis. So I don't think there's anything to worry about in the financial system. But as my colleague Neil Foundley covers in the written edition of the Pulse this month, we do then start to consider what might be the knock-on effects of all of this uncertainty. So, as we've outlined in some of the previous communications, what happened with Silicon Valley Bank was largely caused by the rapid increase in interest rates we've seen in the last sort of year or two. Essentially, that caused some losses on the bonds that Silicon Valley Bank held, and because of those losses, they were kind of in danger of breaching some of their capital requirements, and when depositors saw that, they decided to take all their money out. In some ways, it's got some parallels with what we saw in the UK in the autumn with problems in the pension funds with what we call liability-driven investing, when after the mini budget, some of them ran into trouble because of the increase in bond yields as interest rates went up very quickly. So those sorts of things will have a knock-on effect. I think rising interest rates, rapidly rising interest rates, does have an impact, particularly on the financial sector. So what might happen from here? Well, we do think as a result of this uncertainty, then I do think some banks are going to be more reluctant to lend money to the real economy, and we're already seeing evidence that credit conditions, as we call it, have got a bit tighter. Added to that, there are some potential concerns that they might have of things that are around the corner. We're seeing there being big losses on certain types of property. You've seen some property prices, even residential here in the UK has seen prices fall a bit this year. But commercial property has seen much bigger sharp falls, in particular in things like offices. If you owned some office buildings at the moment, you might not be that sure about the future with people moving to more flexible working, and then add to that those rising interest rates and rising in borrowing costs. That means property prices have fallen sharply, and guess who are the biggest lenders of commercial mortgages? Well, it's the banks, of course, in particular some of the smaller banks. So again, that kind of worry could just have a bit of an impact on the banks and then onto the wider economy. And there's been lots of sort of discussion and lots of research that come out recently that shows just that all this uncertainty in itself tends to have an impact on the economy because it stops businesses investing in the future, and it causes people to kind of put some spending decisions on hold. So all this uncertainty, and in particular the impact of rising interest rates, is just to our minds just causing perhaps the economy just to slow down a little bit. The good news is, though, that we think that if that does turn out to be the case, then central banks can actually do something about that quite easily because they could cut interest rates again. We are seeing some real signs that we think inflation is starting to fall globally, and we have suspicions that it could actually fall really quite sharply later in the year. And given that, if the economy does slow, then central banks could cut interest rates. And that would be positive for quite a lot of investments. In particular, it would be positive for bonds, and we've been buying quite a lot of bonds recently, and it would be positive for quite a few types of the stock market as well. So lots of uncertainty at the moment, lots to consider, but we think, as I say, the banks are safe, but it could have a bit of an impact onto economic growth. So thanks very much. We'll see you again next time.